what's really bizarre is if you're a real estate investor, especially a commercial real estate investor, you are in a deep recession while everyone else still sort of doing fine. The economy is not really in a deep recession, and we sort of what's going to happen? Are we going to hit the recession? In reality, it's one of these weird bifurcated conditions where if there was a general recession, the Fed would lower interest rates. It would be welcome news for real estate. But the fact that the economy is crunching along, it's causing grief for certain sectors, and commercial real estate has been that one sector, or one of the few sectors that they have experienced.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
Big Mike with me, or Mike Zlotnik. I think I said it completely wrong. See, Mike Zlotnik. That's why he says Big Mike is the easier way to call him, is Big Mike. And he's with Temple Funding. And I met him at, I think, the Best Ever Conference is where you and I crossed paths. And I love what you guys are doing as far as educating your investors. You guys have your, I don't know if it's not Tuesday Teas, but it's a thing that you guys do to educate your investors and being able to bring their fund forward. And you have a new fund that I'm also hoping we'll get to touch base on, because it has to do with what's happening in our economic environment today. So, all right, Mike, I'm going to let you talk. Why don't you bottom line your history so that people can understand how it is that you come to real estate, how it is you're an expert in real estate.
Thanks, Christina. So the short version of the Big Mike history, I come to the United States in '89 from the former Soviet Union Republic of Moldova. I went to school here, like most of the geeks, computer geeks and mathematics geeks and chess geeks. I have a degree in mathematics and I'm a chess master. I went through a career in technology. I had a successful career going all the way to vice presidents, directors, depending on companies. And then I switched to real estate full-time in 2009 as it was my passion. I started real estate investing in 2000 passively in New York City. You are in Pasadena, California, and New York City is very similar to California. It's expensive real estate and it doesn't cash flow. So I had my experience of investing in real estate here in New York City, and I realized that it's a great wealth building asset class. It's a passive asset class, and it works. And over the years, I came to realize that's what I really love to do. In 2009, I switched and been running family of funds, Temple Family of Funds, templefunding.com ever since. So that's the brief history of the Big Mike. But I do live in New York City, Brooklyn, New York, with my lovely wife and 4 human monkeys and a cat. I have 4 kids and a real cat.
4 kids and a real cat. So we definitely are human monkeys, without a question. I actually spent a lot of time in my reels and in my social media talking about mindset, as well as talking about the finance of real estate and the due diligence and skills of being a real estate owner. And, there's definitely a lot to say about our monkey brain. And, we're very monkey-like, intentionally or unintentionally. So why make the big transition in 2009? You said you liked real estate. What is it about real estate that drew you from having the job to real estate for your financial freedom?
Well, at some point, it was both circumstantial and decision driven. So circumstantial was that I had a successful career and I was done with the company. I was tired. Instead of looking for the next gig, I said, let the next gig be real estate full time. And there is really no magic sauce to this other than this one word about real estate. And it's not a guarantee. It's just a conceptual word. It's called predictability. Real estate has a lot more predictability than stock market. And you can be the master of your own success in real estate as it's a field where you could do both forced appreciation and you can do natural appreciation. It's a hedge against inflation during the times of inflation, but it also works really well if you know what you're doing, improving properties. So the transition was almost natural. I was really just burned out call it with a success. I was a successful technology investor for technology executive, ultimately an investor. And I was done. In 2009, I was done, and it was perfect timing because real estate market went through a correction, and the time to enter full time that trade was a good time to enter. So it was a good timing from that perspective.
You know, you talk about the transition, and I identify as a geek, although I have to confess I am not a chess master, and I did not specialize in mathematics. I got a bachelor's in business and a master's in psychology. But at the same time, I love doing my research. I love doing my due diligence. I feel like a detective, really digging in on the history of a property or the title. I've had some, I've had some really good, fun due diligence sessions. I'm like, oh wow, this used to be owned by the real estate agent who's now selling it. That's interesting. Like that kind of stuff. Um, but what is it in your history that you feel like really supports you being most successful today? Like you have a strong nerd history, and I believe that nerds do really well in real estate. But what in particular in your case you feel like makes you your success?
So yeah, we can go technically. Obviously, mathematical mind, logical thinking, sort of predictable. Real estate is actually very, what's the word for it? It is not an exact science, but it has a lot of exact science elements. If you go look through the underwriting of many real estate deals, why it's a great deal. It requires Excel work. It requires work with a lot of numbers. It requires testing assumptions, what if scenarios. It requires what they call sensitivity analysis, et cetera, et cetera. So there's a pretty significant technical element to the field. But at the same time, there is obviously a relationship element. This is sort of over the years, it's an acquired skill where I started being a very geeky person, living really with all the geeks. But over time, I realized I really like people. I like to interact with people. I like to network with people. So over the years, I developed that skill, and that combination of both being very methodical and technical in nature, combined with building strong relationships, is a recipe for success in real estate. Because real estate it's a combination of getting a really good deal, which requires relationship approach, negotiations that are driven. Ideally, you are investing with somebody, you're buying the property from somebody, or you're selling a property to somebody. You need that. And at the same time, you got to do your due diligence, you got to do your underwriting, your math, and come up to the conclusion that this is a good deal and explain really why it's a good deal. So I don't know if it's the right answer or not, but this is what appeals to me.
The beauty is there's no right answer. There is no right answer on these questions. It's just meant to be like, let's just explore it. Let's just talk about it. And I have to agree with you that, real estate is not done in isolation. I can't tell you how many times I have said, either on a podcast or in a reel or just in teaching my students in my class, 50% of your success, if not more, is based in your team. Whether it's a team that you're overseeing or a team that has brought you the investment, whether you're investing passively or whether you're investing actively, your team will and does define your success. I just had a student this morning who was telling me about, he's got a mobile home park that he's looking at purchasing, and he's actually already started engaging with the mobile home park. He's like, the property manager at the time would not respond to him, would not respond to him, would not respond to him. And he's like, you know what? The next time I talk to him, because he now has the authority because he's in escrow, he fired the property manager. He's like, you're not talking to me. I can't get control over my property if my property manager won't return my phone calls and won't return my texts. Real basic, right? I can't push control through a human being who's not responsive. So he got rid of that team member, and now he's taken over, for at least for now, managing that mobile home park for himself. And it's just like, if he had not chosen to move that team member, he would have chosen his investment to be unsuccessful.
I'll just have one quick comment on this. So what you described is, I agree with you 100%, and it's all about people. It's all about teams, and ultimately it's a leadership quality. And managing people requires leadership versus the management skills. Although management skills are important, but ultimately it's all about leadership. So the most important concept is having the right people on a bus and putting them in the right seats. So if you got the wrong person on the bus, don't even waste time. You got to get them off the bus. So that's as basic as it gets. And if you're running any kind of a business, you are acting in the form of as a CEO. As a CEO, you really have to think about only three things: people, culture, numbers. And if you don't have the right people, that's a non-starter. You can have a wonderful culture and people who don't want to follow the culture. That's no good. If you have great people, you have no culture. That's no good either. So you need all those three things: people, culture, numbers always work. And numbers, you always have to know your numbers. That's so what you described is a very basic condition of someone not having the right person on the bus. And hire slow, fire fast, right? If you get the wrong person, get rid of them as fast as you can possibly do that.
People, culture, numbers. You just said two things in that I think is really worth highlighting and doubling down on. One is people, culture, and numbers. And so people have a tendency to focus on numbers in real estate. Oh, the numbers is what makes it. The numbers is what makes it. I'm like, yes, you can have great numbers, right? But we just talked about how people can hijack those numbers. Culture is where you get beyond management skills and into the other comment you made, which is there's a difference between just being able to manage people and being able to lead people. Being able to lead people is where culture comes to play.
Yeah. It's management skills is ability to manage tasks, assignments, results. Leadership truly is all about developing people. We could have a whole discussion, a whole podcast, a whole conversation just on that topic. I really believe that to get the best out of people, you need to understand where their genius zone is, what they really love to do, what they're good at, what is their most profitable exercise. You get them in the genius zone, they work 10x as productive as having them do a task that they don't like. So at the end of the day, uh, leadership function is just understanding talents, understanding people's happiness, and then motivating them to be in the most productive state. And if there's stuff that they're doing that they shouldn't be doing, can somebody else do it? And vice versa, should they be doing something else? So it's putting people in the right seats on a bus, understanding their talents and helping them develop. Once you do that, they suddenly um, they transform. People respond. There's a transformation from a job being just a job to this is fun. I love what I'm doing. And if you can get there, then your whole team operates at a whole new level. So
You're a quiet giant, aren't you, Mike?
I'm a big guy. I'm 6'4". So.
I know you're 6'4". I know you're physically tall. I get it, but because I stood next to you, and I looked up at you, right? The quiet giant. But there are people I think that like sometimes I'm okay. Pure personality. I'm loud and obnoxious. Okay, I am much more busy, loud, obnoxious, and opinionated, but hopefully opinionated in a way that is inspiring and draws people forward. Right? It's kind of what I do, and it's one of my ways of being a leader. It's one of my ways of coaching, right? And how I work with people, right? Is I'm clear about what it is that I feel like needs to be done, and hopefully I'm inspiring and positive about how it can get done, right? Whereas I find that your depth of knowledge about how to be a leader and how to be inspirational in your quiet giant way is impressive.
You're too kind. We all learn. I've gone through formal leadership training through corporate executive as well as sort of my own reading and life adventure. So I constantly think about it. At the end of the day, to get the best out of people, you just got to think how to make them happy, put them in a genius zone. And always, whenever you're interacting with somebody, it takes a little while to get to know somebody. But if you can get them to be at their genius zone and they're very happy to be there, that's it. It's just life is too short to do things that are not fun or you're not good at or something that you're not productive at. So unfortunately, too many people in this society, in our world, do too many jobs that are not maximizing their talents. That's life. It's sad statistically. What do they say? 80 or 90% of the people don't like their jobs,
Yeah.
and that's a very very sad reality. So as much as at least what I try to do, I'm far from perfect. Right? I'm just trying. Life is just a continuous journey and improvement. That's all I'm trying to do. Just trying to think that way and act that way. And if I make a mistake, try to correct. That's it.
Okay. So this next question kind of comes out of that, which is, what's the secret sauce of your company? You are the primary leader of your company. So what is it that you perceive as being what the secret sauce in your company is, probably what you wanted to create it to be? So,
Relationships. I would say number one is building strong relationships. It took me many years to build these relationships with the strong operators who are experts in their own field,
mhm.
and with investors who write us checks. So at the end of the day, the success is all about relationships. It's people who you know and know, like, trust takes years to build. You can break the trust fast, and it takes years to build.
Yeah.
So the success of what we do, we invest capital through our funds and syndications, requires these strong relationships, and it's a perpetual journey of building relationships, strengthening them, and then understanding when somebody is on their decline versus somebody is in their uphill, on their ascent. So it's sort of um, this is what we get paid for, in essence, is to be able to pick and choose these relationships, and, like we talked before this one, to solve problems when the problems do happen. So it's not a perfect journey, but it's a journey of understanding who's good at what they need in the next stage, and can we work together? Can we raise them the capital? Can we bring them deals, or whatnot? So the biggest strength are relationships on every level.
It's again, I'm just going to keep doubling back because it's sort of my passion as well, which is, how do you define whether a syndication is going to be successful? We're back to the same conversation again. I have clients all the time. Right? I'm a real estate investment advisor, right? So I specifically work with people in developing their portfolio inside of real estate, or redeveloping their portfolio inside of real estate if they feel it's not working. And one of the things that ends up being the common conversation is, well, Christina, how can I tell if they're competent? They all look the same. All the PPMs read the same. They all seem to have similar returns. Well, how do I know if this is going to work or not? It's like, well, it's the leadership, right? And when you
Yeah,
talk about their genius, sorry, I'm trying to use your words. Like, I talk about it as competency. You talk about it as genius. Go ahead.
Yeah, I'll just add this. So, with all the people who we invest with, who write you checks, we spend time with them. We go to their projects. We discuss quite a bit through obviously conversations, but also feet on the ground, trying to understand how they think, how they do things, how they deal with. It's every element of it. It's communications, right? It's their, obviously, underwriting, how well they underwrite, how conservative they are, ability to solve problems, and you see problems typically develop in everything and how they respond, right? And that's a bigger uh, indicator of a success, is ability to solve problem versus if they catch the wave and everything is going well, right?
Yeah.
Combination of all those things develop these relationships, and it takes a while to do. This is not, I wish this could be done overnight, but you can't. You really don't know somebody. There's a philosophical wisdom that you really need 3 years to get to know somebody, and it's not. There's nothing specific about 3 years. Why 3 years? Why not 3 months? Why not 3 days? And why not 10 years? Right? But at least 3 years helps you, and you have to work it long enough with them and see how they do it through the good and the bad, to be able to assess folks. And I have to say that it's a continuous process, because I've seen really successful people fail when they rely on some idiot they put in the key position. That idiot doesn't do good work, or they steal. And then you see also people who struggle for a while. They find their brilliance, and then suddenly they take off. So it's a very dynamic, evolving process all the time.
It is. I'm going to tell a personal story. It doesn't really belong here, but I'm going to tell it anyways. Part of how I knew my husband was the right person to marry was because the first time we had our first fight, instead of him walking out of the kitchen, he literally just put his hands on the kitchen counter, sat his butt down on the counter, and went, "Okay." I was like, "Okay, we can actually have a conversation. This is great. We can actually. He's just going to stand here in the face of my heat, and we're just going to have a conversation about it." And I went, "Now there is somebody who's going to help me find a solution. There is somebody who's not going to walk away." And I'm just, it's like, how do you know what somebody's strengths are in the heat of the moment, or in when the rubber meets the road. And in real estate investing, the rubber meets the road. Most of the time, there's something that doesn't go to plan. That element is what keeps somebody capable of showing up, getting current information, digesting what there is to do, and being able to find the team members or them themselves to implement it. If you're walking out the door, or if you're busy going, no, 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 don't tell me the truth, don't tell me the truth, it's not the plan, it's very hard to solve a problem. And that problem may cost your investors their savings or their investment.
Well, the first step in solving a problem is obviously acknowledging the problem, and honestly, openly acknowledging the problem. Sometimes it's hard. Sometimes we'll want to hide in the sand and not acknowledge what the reality. But if you acknowledge the reality and you're objective about it, at least you have a chance of going to the next step in the solution solving exercise.
All right. Right now, speaking of that, right now, what is happening in your industry? What is your industry facing in this high interest rate environment?
It's no fun times for those investors who've written checks in the last couple of years in equity. It's just the honest truth, and most people don't want to really face it. But if you've written a check in equity in the last couple of years, you're sitting on thin ice if the ice hasn't broken yet. And depending on where you're at, not every deal, but a lot of deals have experienced higher for longer interest rates, has been a very structurally bad for the commercial real estate. Now, for residential real estate, it should have been an issue, but it's not. The supply chain, the supply demand balance, the disbalance of a lack of supply has saved the residential real estate. Just no product, no properties. Construction deliveries have been well behind the growth of demand. On the commercial side, a lot of deals trade as a function of the cost of money. The cost of money are basically availability of the bank's financing and the interest rates. And the credit tightened massively in the last couple of years, with banks withdrawing their financing, lowering their leverage, and increasing interest rates as a function of the central bank pushing rates. So the consequence is that many deals are just there to survive for now. It's a survive until, let's just call it 2 years from now. And then if you can't survive, then some of these deals will go south. And it's been difficult. It's creating new opportunities. It's creating great opportunities for fresh capital, for fresh dollars. But the dollars invested in 21 and 22, unfortunately, are not really in great shape. Now, 2023 investments have been much slower, very few of them, and very few selective deals. Some of those are probably fine. So if you're talking about a big picture, that's from an interest rate perspective. Now, if you go sector by sector, it all depends what subsector you're in. If you are, as I mentioned, residential real estate, you're fine. Interestingly enough, open air shopping centers are doing well. It's been lack of supply as well. Self-storage is beginning to get oversupply in a number of markets. Multifamily, again, price corrections in sort of, I just call them the Sun Belt, has seen significant price corrections. Midwest has done relatively, has been much more stable. So it depends on the asset class. If you're on triple net industrial, you're probably fine. If you're sitting with long-term, great leases. So the office is a dog shit. I mean, I don't know how else to put it. Like if you're in an office, COVID dislocated that in a horrible way. So office probably hurt the most. Multifamily has been impacted. Storage is getting impacted in some regions. But at the end of the day, for fresh money, it's a great opportunity now. So if you are ready to write a fresh check and you're patient enough and you're able to underwrite, you may be able to get phenomenal deals and take really good risk-adjusted returns on a forward basis. But if you've written check last couple of years, you're seeing nervous and concern, and nobody's going to tell you that things are hunky-dory. If they're telling you that, then it's a bunch of bull.
Yes, it is. It's a bunch of bullpucky. how is your company managing this? I mean, you are a fund of funds. You are using your own genius, if you want to call it that, to be able to choose what you're going to invest in, both on people and asset levels. So your company must be experiencing some of that fallout and still moving forward. I know you guys right now have a fund that you're putting forward that I actually want you to tell people about, because I think it's an important fund that people should know about.
Sure. So on a forward opportunity basis, we launched Tempo Advantage Fund. That's a brand new fund focused on providing mass financing. Let's just call it rescue and recovery capital for some of these deals that have run into liquidity challenges related to the higher for longer interest rates. So we're underwriting these deals. We've already underwritten a number of them. We financed a number of them. We continue to do that. And the WARFI deals that still have fundamentally strong real estate, but they just short liquidity, they're getting mass financing. Typically, mass financing comes in behind the primary debt, but ahead of all preferred and common equity. So that's, by the way, I see a great area of forward opportunity. We're raising capital for that. We continue to write fresh checks in that arena. As far as existing deals, we're very open, transparent. This is the most difficult thing to do as a fund manager. It's painful to tell people that the checks they've written in some of the deals or funds that were focused on growth are likely going to lose some money. Some of them may lose a lot of it, some may lose a little bit. It all depends. Ultimate results are unknown, but we're very open, transparent. We're holding open communications on every fund, every syndication. We're letting people know how it is, and we're not trying to hide anything. So at least folks know where they stand. And we are raising capital for the WARFI projects. We're very focused on getting them the capital so they have a chance to survive and succeed.
Yeah.
At the end of the day, what else can you do as a fund manager? We're working obviously with operators who are running these projects and trying to understand what do they need, where do they need, what's a higher priority, what's lower priority, where do they need dollars, what else can we help them with besides capital. So all these are open conversations that do take place, not always fun conversations, but that's what life is all about. It's just you do the best you can, you communicate openly, and on both sides, sponsors and investors. And then the most difficult thing as a fund manager is uncertainty. Right now, and we started this whole conversation with a word, what do I love about real estate? And I gave you the one word called predictability. Now the predictability is way weaker, way less. Generally, real estate used to be predictable when the interest rates were stable. Today, we don't know where the interest rates will settle. And that environment, it makes predictability a little bit less, a little bit more difficult. And that's my personal struggle. What we can all do, compute when the variables are known. When you don't know what the variable is going to look like, the computation becomes a lot harder. And that's the biggest struggle that we have today, what the future holds. And there were periods of time, all we need is stable interest rates. We don't need necessarily very low or very high interest rates. We just need stable interest rates. But we don't know what it means because the government, the fear now, they're going to keep printing a lot more money, which will cause more inflation, which will cause high interest rates, et cetera, et cetera.
Mm-hmm.
If we were just stable for a little bit, that would be so much nicer.
I think you said that really well, Mike, that stable because once you've stabilized, you've got a purchase that you have, it's an asset, it was reliant upon a certain interest rate. One of the many variables that went into the due diligence was a particular interest rate. And maybe a little higher, maybe there'll be some increases, but not triple. So now you've got it and you're like, okay, crap. Now let's see what we can do to save it, quote unquote, save it. Survive till 2025, right? Survive to 2025 was something I was hearing going around. Now I got to save it. Once you've saved it, once you've gone, okay, here's the new set of calculations. Well, then that works, doesn't it? As long as the rate is stable. Now you've got another working building, even if it was more capital being put in to stabilize it. Now it should pencil back out again. And I think that's important that people understand that dynamic because it's very easy in a downturn. I've been in a couple myself. I started investing in 1986. So I've been in a couple cycles, 2007, 8, 9 being the biggest lessons, right? We're in that time period because that was the biggest downturn. But I think people should understand, my listeners should understand specifically that it really is about the financing going awry. And then once you've restabilized what the expenses are, then now you have the cash you need. You have the rents coming in because residential isn't having a huge onslaught as far as rents going down. Some, yes, right? Then you now have a restabilized deal. Well, that deal will hold. And that's the intention of a capital call, is to get the deal to hold. Because people are like, well, why would I put good money after bad? And I was like, well, wait a minute. Are you sure that new good money is going to be bad if you can restabilize the deal? And I've been trying to really encourage people to look at, when you get a capital call, look at it from that point of view.
Yeah, I'll add a couple of comments here on the capital calls. So capital calls have been struggling. They haven't really worked well. And I've seen quite a bit of data, and really only about a third of the needed capital gets raised through capital calls. Most investors just don't give them the money.
Mm-hmm.
They just don't believe that the sponsor is actually clear what they're doing, or they can get the enough capital to get it to a stabilization point.
Mm-hmm.
We approach the same problem from a mezz debt financing. How do we get to a finish line? What does a finish line look like, first of all?
Mm-hmm.
And then can we get there with enough capital? And if you can get there with enough capital, then you can have the project survive, and then you can get to a point where you see the market recovery. The biggest problem with interest rates moving wasn't just the fact that they moved, but they moved fast and furious. And very few people assumed the interest rates would move so much. So the inflation and the rising rents have been a friend, but the changes in the cost of money have been just too big, and that's why a lot of these projects need to go through a re-underwriting today. And part of the process is half the deals are just not, they don't even pencil. What it means is if you're getting a capital call and a sponsor is hoping to get through 3 to 6 months, but they don't know what's going to happen in 3 to 6 months, that's really a risk of a bad money after good, because the value is just not there.
Mm-hmm.
And we've gone through enough of these conversations where we write these assets on our books as a zero. I hate to put it this way, but you got to know.
Okay.
You have to do the triage. At the end of the day, if you have a portfolio of assets, as a fund manager or individual investor with a bunch of assets, if you've got very, very sick patients, and you can only focus your time, energy, and resources on the few good ones that have a chance to survive, you need to know which ones are mortally wounded. And the mortally wounded deals are the deals. They don't pencil. Even if you gave them a bunch of money, it's not even clear what they're going to sell for, even if they fully stabilize, right? So this is the biggest challenge,
Mm-hmm.
that a lot of deals unfortunately fall in the category that the high interest rates put them in a position where it's just too uncertain whether they can actually exit at the right price, even if you get them to stabilization. And that basically makes the decision very easy. You just unfortunately call them, it's a triage. This patient is too sick. The chances of survival are too low, and you move on. So this is back to the whole exercise of the best opportunity is to know what not to do. It's kind of like you just say, this is no good, 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 and you eliminate all the no good situations, and then the few that are left are the worthy ones, and then you can clearly see why, because you've seen enough of the challenging situations. So it's almost, to know what's a good deal, you have to look at enough deals that don't look good. So that's kind of the reality. And at this point, what's really bizarre is, if you're a real estate investor, especially a commercial real estate investor, you are in a deep recession while everyone else still sort of doing fine. The economy is not really in a deep recession, and we sort of talking about what's going to happen. Are we going to hit the recession? In reality, it's one of these weird bifurcated conditions where, if there was a general recession, the Fed would lower interest rates, it would be welcome news for real estate. But the fact that the economy is crunching along, it's causing grief for certain sectors, and commercial real estate has been that one sector, or one of the few sectors that have been experiencing that.
Well, and commercial real estate, multifamily, yes, and absolutely, definitely, and it's, if the Fed were to start decreasing rates right now, I'd almost be concerned. I'd be concerned both in the real estate market, they would start overheating again quickly, but also in the economic market, because I don't think we've seen quite enough slowdown yet, given the amount of currency that's in the system. But that's my personal opinion. That's just my personal little crystal ball conversation.
Well, we can get off the tangent on the topic. This whole economy is bifurcated. It's very difficult for some folks. They're running up credit card balances. They're tapping into retirement savings,
Mhm.
while the other ones are just doing really really well. They've got a lot of money during the COVID. Let's just call them dollars transfers from the government to the businesses and individuals. So it depends on the point of view. If you are the does this call them the 20% who's enjoying really great days.
Mhm.
Um, things are wonderful, but a lot of folks, and this is something that there's no easy solution. And unfortunately, these higher for longer rates are not necessarily doing what they need to be doing. They're not necessarily fighting inflation. In fact, the crazy part is the higher interest rates. Part of what they do is they fight inflation. On the other side, they're paying much higher interest rates on savings and the investments, and that's creating more dollars that can get spent. But who is getting those dollars? Those folks that have large savings.
That's
It's a very
exactly.
simple. And I am not socialist. I'm not advocating a redistribution of the wealth. I'm just quoting on the fact that this whole environment is very. It's a bifurcated economy. It's not a good economy for everyone. It's more of a. There has to be ways to help folks at all ends of the spectrum to give them good opportunity and at the same time, I guess, move us forward. So
Yeah, no, and actually, I have a slightly different opinion, if I may. My slightly different opinion is that I feel like the Fed is creating part of what it wants to create, which is we now have burned through our savings because the savings shot up during COVID because of all the transfer of wealth from the government to the people. And then from there, our savings rate is back down lower than it has as a norm, right? So below 3%. And now we have credit card debt, right? Up to, I think it's 1 trillion. And in some states, we have default on credit card debt up to 30%. In Arkansas, that default rate is now 30%. And other states are even higher, but I'm looking at Arkansas currently to purchase in, so that's why I happen to know the Arkansas number. But so we're seeing defaults on credit card debts, and that means that people are running out of money to spend. And when people run out of money to spend, whether it was their savings or their credit cards, and they start hitting those limits, then we're going to start seeing people just going, okay, fine, I can't purchase, I can't continue to sustain, I can't, blah blah blah. And that's when we start to see the crumbling inside of the capacity to afford in the everyday man level. And I think the Fed is starting to get there, but because wealth is still moving, like you said, the bifurcated market, we're still seeing people buying real estate, and we're still seeing the stock market continue to go up. And so we're still seeing economic indicators that we're actually recovering because people are like, woohoo, the Fed has stopped increasing rates. Let's go party. And it's like, well, someday this ship is going to come to an end if the Fed holds rates higher longer. My concern would be if they actually increase rates, because then they're going to create a break in the system if they increase rates, because we're on that edge. We're there.
they don't need to increase rates. They just need to hold them higher for
There's-
longer, and then they'll crush the consumer. Exactly what you said. The consumer is gradually getting destroyed. They just need to hold it longer enough where they're going to crush the consumer, and the crash will be hard. And when the hard crash comes in, then the Fed is going to go back into the emergency room medicine, saying we got a really sick patients, we got to cut rates.
That's right. Yeah, that's what they're going to do. All right. So thank you so very much. I'm going to leave the last two questions unasked, but I will ask you one more question. What does financial freedom mean to you? We involve ourselves in this complex field called real estate so that we can achieve the vision in our head of what it means to be financially free. So what does financial freedom mean to you in your head?
So you probably heard this answer many times, but it's really, really basic to do things with the folks that I like, do it when I like, and how I like it. It's kind of like financial freedom. Really, money is just buys you time ultimately, right? You're trading off dollars for hours.
Yeah.
So financial freedom is really buying your time back and being able to also spend that time with folks that you like, you're happy to with. Life is too short to be hanging out with people who you don't like, and that's the financial freedom. It's just buyback of your time, And also, obviously, it helps to do good things. You wind up having more time and more resources to be able to help those who you believe need the help. That's what financial freedom means.
Yeah, I agree. I think everybody worries about money and we get used to having a money budget. But I think not everybody understands that time is really the element we're really wanting to have control over. Our time. What we do with our time, what we make a priority, how we invest our moments of living is really how we get to experience our life. And time is what allows you to do that. Money is just the vehicle for having greater control over time. But we could just
Agreed.
have more control over time. I'm just saying, I'm just suggesting instead of waiting for the money to show up, there is that as a possibility as well. Work for an employer that sees your genius so that what you do in your day is satisfying in your work hours. That right there gives you greater quality of time, the time we have.
Yeah, for sure. I'll just add this comment. Unfortunately, you spend a third of your life working, right? Think about it. You spend 8 hours a day working of every day, right? I mean, if you exclude the weekends, but the concept is, maybe 30% of your time, of all time, is spent working. So you just got to find a way that whatever you do it happily. Then you gain a lot more time back because you're spending it a lot happier, a lot more productively. So.
Beautifully said. All right, Mike, how do people get a hold of you now that they've had a chance to check you out, listen to your level of expertise, your point of view on investing, and who you are as a human being? People want to connect with you and invest in your fund or ask you questions, invite you to their podcast or any variety of things. How do they do that?
So Big Mike, right? That's what I go by, and I'm a fund manager. So bigmikefund.com is the easiest way to remember. And if you misspell it, you just don't get the D at the end. You kind of omit the D, and you wind up going bigmikefund.com. I promise it's not a kinky site.
That's good. That's good. I like it. Seems pretty straightforward. So Temple Funding is also the site.
Corporate site. Templefunding.com is a corporate site. Bigmikefund.com, easy to remember. You'll wind up at a page where you can go listen to the podcast. But you can navigate from there. You can schedule time to chat. There is a scheduling link, all the good stuff.
Beautiful. And the podcast, of course, the reason why us podcasters even do these podcasts is so that we can educate the people that are in our communities and in our circles. So I always respect other podcasters because I know that the true passion isn't necessarily that we're being paid so well to do it. It's because we're looking to educate people so that they can get a better understanding of how to be better investors. Thank you, Mike. This is Christina Suter with Real Estate Breakthrough. So good having you here listening. You can see the next podcast on my YouTube channel, iHeartRadio, Spotify. I believe I'm also on Amazon TV. Apple TV's been down recently, so you can't watch that particular one, but also Roku and lots of other platforms. I will see you guys again in 2 weeks.